So yes, we can see you, Jesse. Professor Jesse Keenan, he's professor of real estate at the School of Architecture in Tulane, New Orleans, Louisiana. It's a real pleasure to welcome you, Jesse. Jesse, I would say, even though he's in the School of Architecture, he's the US's top climate finance researcher. I think whilst the finance faculty and departments have been asleep at the wheel, this guy has really been leading the way. He is involved in several startups in this space. So when I talked about there's an arms race, so he's involved with a firm called Juniper. I think there may be other firms that you're involved in. He has a long and distinguished career, and he was previously at Harvard, where he headed their real estate and built environment a team. I won't say any more, just a very impressive CV. It's a real pleasure to have you here, Jesse, and I will hand over to you. Your topic is climate change in challenges in modeling climate finance risks. So welcome, Jesse, and it's good to see you. I think we caught up maybe 4 or 5 months ago, and it's good to have you virtually here in New Zealand.
Well, listen, thank you so much for the invitation and the opportunity to join you all. And I want to take the time today. First of all, thank you for the very generous introduction. I would argue that I'm certainly not among the climate finance faculty in the United States, certainly not among the vanguard. There are many folks who fall into that realm. But I fell into climate work a number of years ago, incidental to physical and transition risks associated with infrastructure and various other assets of the built environment, which was my core disciplinary domain. So in that context, I saw both risk and opportunity. And that opportunities were grounded in analytical dimensions associated with emerging ideas, what we now call prop tech, and broader technological and proprietary advancements in the flow of information and data to more accurately price and manage real estate infrastructure systems and the like. And that has extended well, I think, in some dimensions to climate and to informing decision making. But as we saw from the wonderful presentation in a previous presentation here, it's not such an easy thing. And the degree to which we measure and adjudicate scientific uncertainty and those parameters of financial investment decision making are indeed quite distinct and a major methodological but also fundamental challenge as a matter of policy. So that's what brings us here today. I wanted to give you a little bit of insight in what's happening in the United States. And so I'm going to focus in on climate policy and climate finance policy. And I'm going to orient this to a fairly broad domain of financial economics and implications for financial economics. And we can look at this from a federal perspective and understand what's happening in the Biden administration. And really, it's about federal policy that impacts climate finance as opposed to climate finance policy. And that's an important distinction, and one which I think opens the door for a much broader horizon of understanding. So we could divide this between mitigation and adaptation realms. And in the adaptation realm, we see agency and department plans across the federal government working on several major things. We'll talk about this in a little bit more detail. A calibration of government lending and insurance programs, TCFD participation, and associated modifications of government accounting to support disclosure and fiscal management associated with short and long-term physical and transition risks, as well as subsystematic and systematic risks of the macroeconomy. In the mitigation realm, you see most of the activity focused on core financial regulatory agencies. And here, the principal focus is defining metrics for ESG financial products, the sort of greenwashing, where do we draw those lines? Expanded fiduciary duties for pension and retirement accounts. And again, TCFD disclosure for public companies on the horizon. These are the principal activities. For those of you who are not familiar with the American model of financial regulation that is indeed unique, and somewhat unique by virtue of the diversity of our various economic sectors and the underlying complexity of that in securities, derivatives markets, you name it. If you're interested in a little bit of background information here, and in fact, what you could understand as a roadmap for the current presidential administration, there's a document or a publication called Managing Climate Risk in the U.S. Financial System. This really is the roadmap to much of the policy that we see today. I had the pleasure of serving as the editor of that for the U.S. Commodity Futures Trading Commission, together with Leo Martinez Diaz, who now essentially leads climate finance for Secretary Kerry at the U.S. State Department. It's a great outline in terms of domesticating international practice in many ways. The United States is many, many years behind much of the world, as you understand, in terms of various types and forms of climate policy, particularly climate finance. And this is a good survey of physical and transition risk unique to the American vernacular, systematic, subsystematic risk, a review of what we think is happening globally in terms of regulatory action, enterprise level orientation to climate risk management and data, a great review, I think, on climate scenarios and the role that they play, and then on and on, net zero transition finance. There's dozens of recommendations here. Many of these recommendations have now actually become policy. So it's a good foundation document, and it's free online for you to resource. So let's just jump in and think about the United States as a truly sort of federalist entity associated with lots of different sector-specific and mission-specific administrations. Here we're looking at the Climate Action Plan for the U.S. Department of Agriculture. And I just want to highlight a few different domains of regulation that have some impact or relationship to climate finance or the broader economy from which a financial economy wrestles with climate change. And here the USDA, again, Department of Agriculture, is really honing in on data and information exchange, particularly as it relates to agricultural practices. Now, climate, there's been a number of different, let's say, advances in terms of agricultural intelligence associated with crops, crop yields, environmental data, and the alignment of that with crop insurance, private sector crop insurance. A lot of this has come out of the United States in recent years, but really amplifying the transparency measures here for broader accessibility to a wide range of stakeholders. So thinking about everything from monitoring soil health to water quality, quantity issues, a wide range of environmental parameters that also speak to measures of yield and other subsystematic dimensions of production. When you're talking about crop insurance in particular and managing the associated risks there, we see some interesting innovations here associated with revenue protection products. Associated with different types of multi-peril coverage, which we haven't seen in the past. And that includes beneficial coverage for diversification of underlying crop selection and rotation time of year, and shifting production requirements to accommodate climate change period. And this has always been a major role, certainly something we can understand within the WTL elsewhere of how you manage production, but certainly this idea of managing production in time and space relative to some measure of anticipated impacts is tricky, as we saw again in the previous presentation, but something that they're honing in on. On the other end of the spectrum, when we think about applied science, we think about NASA and what they're doing. And in their recent climate action plan, they're really thinking about the next generation of climate models. You would anticipate that from them on some level, but really integrating the forecasting and the weather to climate domain, which was highlighted. But all of this is being distilled to a level of asset level hazard exposure analysis within their portfolios. And I think what you see, and this is a good resource For those of you who are interested in portfolio level exposure analysis, they're really trying to integrate multiple different data sets that speak to essentially indicators of exposure and to understand the varying technologies to mitigate and manage that exposure across a portfolio. And I think it's a quite an interesting model for enterprise risk management as much as anything else. We have our great science agencies within the Department of Commerce: NOAA, National Oceanographic and Atmospheric Administration; NIST, National Institute of Standards and Technology. And what we see here is the science and applied science coming together to think about infrastructural performance requirements, codes, design standards associated with a wide range of physical assets that is really critical for life cycle analysis for both adaptation applications, but also carbon footprinting, among other things. And also thinking about, on the other end of the scale, we can think supply demand, if you will, in terms of demand, new measurement products and indicators at the US Census Bureau to understand shifts in population, which is so unbelievably important on so many dimensions. We have a lot of very high exposure areas here in the United States where we anticipate some measure of intra-county, relatively local or intra-regional climate migration. In fact, we've already started to see this. Another dimension within this broad portfolio of regulation is the idea of fast tracking patent process for adaptation related technologies. I think this actually holds a great deal of promise. How one does that and how one parcels by and between what is adaptation related and elsewise is somewhat complicated, but an interesting ambition, one I'll reserve judgment for later. They're also thinking about how they can prioritize climate into economic development administration and thinking about the primary applications. You know, we're also looking at this from the Department of Labor point of view, thinking about community economic resilience. Of course, as many of you may recognize, there's a great split, and I would say probably the majority of economists these days don't really believe in the idea of endogenously derived deterministic resilience in economies, that the exogenous nature of dynamic resilience, something that we in theoretical terms can relate to in the transformative capacity of even socio-ecological resilience in complex adaptive systems, makes a lot more sense from a modeling and theoretical dimensions. But nonetheless, what they're really talking about here is community resilience, and what that fundamentally means is a new set of underwriting criteria for the deployment of capital that which can be catalytic to our similarly guided ends or policy goals. Again, it's a tricky dimension, and it highlights the extent to which there's not a well-grounded range of defined terms that speak to legislative intent associated with things like sustainability, resilience, adaptation in their various forms and applications. At the US Department of Defense, again, extending the applied science to really think about monitoring data intelligence, and they're really have a supreme amount of expertise in bridging strategic and operational and tactical decision making in matters of uncertainty and deep uncertainty, as you recognize. And that for them means everything from training and operating in extreme weather to new environmental operating conditions for assets, which is critically important. But really, the value here in the context of what brings us here today is leveraging their R&D capacity to promote a wide variety of innovations that speak to resilience, adaptation, and mitigation ends. And there's a long, well, not long, but there's a very unfortunate history here for things like energy resilience coming out of gas convoy casualties in the Middle East wars, unfortunately. But at the end of the day, the real impact here is government contracting and procurement. The Defense Department alone spends about $500 billion a year in government contracting. And when we start to think about climate risk management and the various dimensions across assets, products, services, and the like, and the extent to which we begin to understand risk and internalize that risk within contracting dimensions and procurement dimensions, it has a significant impact for the broad private sector as well. Our Department of Homeland Security, one thing I wanted to highlight here is the extent to which their emerging adaptation plans are really starting to think about cyber and cyber physical interactions, and that includes a greater attention to stability features associated with climate driven instability phenomenon. And this plays out in so many different dimensions. From our Environmental Protection Agency, what we see is the beginning of the internalization of climate-related criteria, both mitigation and adaptation, for a wide variety of grant and fund programs. And what we see in the United States is the emergence of new public finance programs, primarily centered on revolving loan funds that are essentially subsidized or interest subsidized revolving loan funds that turn over, that essentially are financing the incremental costs associated with resilience and adaptation interventions. That is to say that you're taking normal projects that have some dimension associated with, let's say, designed adaptive capacity, and you are financing that incremental additional cost burden, which may not otherwise be reflected in your conventional modes of capital planning. Within the U.S. Department of Housing and Administration, which regulates housing and urban development, I'm sorry, it's late here, so you'll have to forgive my slowness off the bat, which regulates directly, regulates about 60% of the housing market. They are in the process of developing a few interesting loan products that incentivize higher building standards, incentivize improvements for energy and things like that. But really what's important here is that they're beginning the process to develop a transaction-ready system for climate and flood in particular disclosure that will begin to ultimately manifest itself in what we see in the capital markets associated with climate risk premium. So Fannie Mae and Freddie Mac, what we call the government-sponsored entities, which are floating much of this agency debt, second most liquid debt in the world, I believe, is beginning to price in geographic concentrations of risk, for instance, within the mortgage market. To have greater discipline, ultimately, you need essentially a property by property transactional system that can understand varying degrees of risk and, of course, uncertainty associated with future conditions. The General Services Administration is the agency that's tasked with owning the government assets, cars, vehicle fleets, land, property, real estate, everything that the government owns. And what they're really getting into is, one, developing this vast array of modifications associated with the contracts and risk management, and developing new tools for portfolio management across their various asset classes. But the most important thing that has been committed here as a matter of policy is beginning to implement TCFD disclosures. And to do that, they're really leading the way for scenario analysis and standardizing reference scenarios for the GSA pursuant to TCFD specific guidance. They've already started in about 100+ capital projects to assess that climate risk, internalize it with environmental impact assessments. And really, at the end of the day, they're trying to build that project finance level case. We can understand this in cost benefit analysis, however you want to look at it, cost effectiveness analysis, variety of different methods legally, but they're building that case for how one measures the underlying reduction in risk and the opportunistic dimensions from managing that risk in the long term. Our Department of Treasury, U.S. Department of Treasury, is doing an awful lot of things. Of note, they are thinking, sort of strange to think about this in a way, but they are thinking about population migration. Why? Because people take their money with them. They're also thinking about our Internal Revenue Service and taxes. They're thinking about people and businesses on the move with climate change, in part because they have to collect taxes. They need to understand where our economic base is shifting to. There's a lot that they're thinking about in terms of facilities and business continuity, of course, within the financial system. That includes reducing our reliance on paper checks, which is a somewhat controversial proposition in some disadvantaged groups who rely heavily on paper money outside the banking system in the United States. But nonetheless, this is the full range of thinking that speaks to really operations, both internal and external mission. What I want to highlight for you in the final minutes that I have here today is an Executive Order 14030. This is U.S. climate-related financial risk, and this is an underlying sort of guidance document that was published just recently last month. And here we see a framework and a whole government implementation strategy. And I just want to highlight a few things. I'm running a little late here, and I'm going to speed up. You know, what what we see in terms of mobilizing the private sector for a net zero transition is not much of a strategy, unfortunately. There's not a lot of clear terminology. The idea of risk reduction and multiples, it's really not quite clear. The United States really doesn't have, I would say, a very strong case at this point for mobilizing, let's see, ESG qualifiable investments or green qualifiable investments. And this is somewhat problematic in part because our Federal Reserve has undertaken so much quantitative easing or asset purchasing, from which we believe we have the full regulatory authority to have greater analysis and understanding and transparency is about exactly what the Fed is buying and the extent to which that represents physical and transition risks, which are essentially unacknowledged on the balance sheet of the United States. Non-strategy here as it relates to net zero transition financing domestically. There's a lot of talk about protecting vulnerable populations. This is a political outcome, as you may imagine, but there's a lot of methodological ambiguity and really vagueness ultimately about how one methodologically calculates some of these goals that we're setting for ourselves in terms of percentage of overall benefits accrued from major catalytic public expenditures in infrastructure and in climate across the board. And this is a really fundamental challenge in many ways. Now, the federal government itself has multiple dimensions of risk: flood, crop insurance, procurement risk, pensions. They manage the pension assets of hundreds of billions of dollars. And really, the entire macroeconomy represents some measure of risk. So safeguarding the US financial system in the context of these various emerging thresholds for systematic and subsystematic risk, it's tricky. But this is what they're trying to get into. One, global leadership, beginning to participate in NGFS more substantially in recent years, as well as Coalition for Finance for Ministers on Climate Action. It's one thing to say, it's a whole other thing to do it. But let's get to the meat and bones of it, financial regulation. So what we see here is the ambition to begin to launch climate risk assessments that are really stress tested. And you may or may not be privy to the idea of stress testing in the United States, but it came after the last financial crisis as a means to understand too big to fail, and they understand the extent to which capital asset allocations may be balanced to accommodate for unusual risk taking or imbalanced risk taking. That's an important thing. Before we can even think about stress testing, we have to develop these reference scenarios. Stress testing is a bit of a dirty word in the United States, or at least in the banking industry. But we're getting to that process. And all of this, in many ways, is based on our engagement multilaterally, particularly with other countries, in shaping TCFD and the public application of TCFD, which we really have zero advanced thinking on, and we're playing catch up to the private sector. We have something called the Financial Stability Oversight Council, which is really leading the charge, and I'll come to that in a second, in the United States, on thinking about financial stability. And there's a lot of important things going on there. The regulation is also working in the insurance realm to begin to understand with state regulators. Insurance in the United States is primarily regulated by the states, not the federal government, but to begin to understand climate impacts and the asymmetry that's happening among a quite distorted insurance market in the United States. A number of markets, for instance, states for insurance markets, for instance, essentially cross-subsidize states like Florida and California for their disproportionate amount of, let's say, tropical cyclone and wildfire risk. It's an extremely imbalanced system on many ways of thinking about it. And ultimately, there's work ongoing at the Securities and Exchange Commission for relevant disclosures or material disclosures associated with publicly traded companies. Of course, big problem there. What do you do about private companies? Within the American Savings and Pensions, they have moved forward with policy shifts in the Department of Labor for what we call ERISA plans, which is about $12 trillion in assets under management, about 54% of American retirement plans. And basically what we're shifting to here is allowing fiduciaries to consider not a requirement that they consider, but allowing them to consider various ESG questions. And there's some real case law about the fiduciary application of ESG, particularly the S in ESG dimensions and what that is really going to mean. But no matter what we do, we have to align this rule with UK, EU, Japan, Australia, and others who are far ahead of us. In terms of federal procurement, just federal procurement, non-military procurement, it's about $600 billion a year. The Federal Acquisitions Regulatory Council has put in two emerging policies. One is that federal contract activities or contractors must disclose their climate risks and greenhouse gas emissions and establish a science-based emissions reduction target. And fundamentally, it's allowing federal agencies in the procurement process to consider climate risks and greenhouse emissions in the selection process. So it's one thing to impose the disclosure mechanisms and outcomes associated with that. It's a whole other thing to think about utilizing that as a factor for selection. Usually in a low-cost bid selection criteria, that's a fairly important move. Within the federal government itself, federal budgeting is really moving quickly and at first in qualitative terms and ultimately through the Federal Accounting Standards Advisory Board to develop the quantitative measures for understanding climate risk. And we anticipate that the president's budget next year in 2023, fiscal year 2023, will include a long-term budget outlook that includes various risks and uncertainties. There's other things that are happening within the private sector associated with climate financial risk or risk management standards associated with assets like flood risk management and a broader ambition for climate information services that I think will be the focus of our panel. I'm going to kind of skip over this now. You can think about this as a matter of consolidation and coordination among very disparate entities. In returning to FSOC, the Financial Stability Oversight Council, there's a number of different things happening here. One is an ambition to internalize climate within a wide variety of relevant risk reporting that happens. Taking that a step further in terms of oversight of relevant banks and financial industry providers is emerging, if you will, for a lot of different reasons. We can talk about that. One of the things I want to highlight with FSOC that's important is they're really thinking about, as we progress forward with regulation and greater prudential oversight of regulated bodies, what do we have in terms of data? What do we need? How are we going to share that data? Believe it or not, even between federal agencies, extremely difficult to share data, particularly financial data, which often has privacy considerations and not so easy to share. So what we see here is an emerging ambition to standardize scenarios, forecasts, and really other tools in alignment with NGFS and FSB. And I think that development of consistent standards, definitions, and relevant metrics, as they say, or as is quoted here, is really absolutely critical from greenwashing all the way so that we can have a common language for understanding various scenarios. So as we move into greater TCFD compliance, consistent measures of scope 1, 2, and 3 emissions are important. Thinking about SEC is currently working on ESG registered funds and advisors, so a new level of certification essentially with funds and advisors, which would be pretty groundbreaking if it were to happen. So I would say we're in process on the prudential front, and much needs to be done in terms of coordination with international financial reporting standards and for accounting and auditing to really reinforce the regulatory impetus. So what do we need? We need standard definitions for sustainability, resilience, adaptation, ESG. We're beginning to develop consensus-based orientation multilaterally with other countries about what those definitions are, what they mean fundamentally in terms of quantitative benchmarks as much as they qualitative legislative intent associated with these core definitions. And I say definition in a much broader intent here. Need for standard reference scenarios, which we are linking and working and operating to connect sectors and various responsible regulatory agencies. They recognize that just looking at ag derivatives and just looking at futures and just looking at publicly traded companies in isolation is overlooking an awful lot of subsystematic risk. We need standard data formats for disclosure reporting and auditing, which is going to be really critical, particularly for the auditing end of the equation. Government accounting, as I just mentioned, is really going to have to catch up with TCFD ambitions. We're just not there. We're getting there. We've had a lot of experience, but we're not quite there. And we need to balance public climate data and the ambitions to develop measures in accessibility and transparency with government-funded data and some measure of post-processing of that data and application and relevant indicators, I should say, with the proprietary R&D and intellectual property of a emerging class of climate service providers. In addition, next, we need to think about materiality with the proprietary dimensions and the opportunistic strategies. So what do we mean by the material important things in the realm of disclosure? Is a legal question, and materiality is going to hide a lot, particularly as it relates to proprietary dimensions of enterprise strategic management, ultimately. So how do we tease out what is material, not so material, what is proprietary within the context of disclosure is something that will require a great deal of litigation going forward. Need to engage privately held companies, not just banks, insurance companies, and publicly held firms. So we have a fairly narrow class of regulation from which private equity and the private end of asset ownership is largely excluded from policies right now. And ultimately, what we need to do in the United States is impose a carbon tax. And there's a great deal of consensus about this among, and it has a fair amount of bipartisan support. And there is some realistic talk of setting a carbon tax much sooner than later. But that's the subject of an entirely other conference and convening and proceedings. So I'll stop there, and thank you very much for having me. I'm sorry this is a whirlwind. I'm sorry it's late here, so I'm a little slow this evening. But thank you for having me. I look forward to hearing from everybody on the panel.
Fantastic, Jesse. Really interesting stuff. A couple of conclusions from my end. The Biden administration's been busy. That's for sure. It strikes me as a lot of these things are new. The other thing that sort of strikes me as coming from originally from Europe and being in this part of the world as well is actually always struck me as one of the strongest advocates to dealing with climate change in the US has been the defense industry, right?
Yes.
Some of the most outspoken, whereas in Europe, it's really been politicians, it's environment ministries, green parties that have driven that. And ironically, in the US, it's the defense industry, those people that understand risks in that long term and how they might play out. The other thing that really struck, well, a couple of other things struck me is just how much is going on was really impressive. So it's really, you really have a huge handle on and you were just touching on the federal level, right? And you never got to the state level, which probably is a different conversation in its own right.
Particularly with public finance.
Yeah. And then the other thing is the issue of migration, right? Because the US is a big country, Americans are used to moving, right? And so, whereas other populations may be less mobile, maybe people in bigger countries may be used to this. So definitely that sprung out. I'll see if there's any questions on the floor or online, and if not, we'll just move straight into the panel. And no, any questions? No, we'll move on.